Now, we certainly live in some interesting times. 2 weeks ago, Mervyn King, the former Bank of England boss, stated that the world economy is sleepwalking into a new financial crisis. King said it was time for the Federal Reserve and other central banks to begin talks behind closed doors with politicians to make legislators aware of just how vulnerable they would be in the event of another financial crisis. Now, as well as this, last week the New York Fed announced that they have increased their overnight repos to $120 billion, which is 60% more than what it was capped at $75 billion. Apparently the Fed needed to do this in the middle of the day, outside of their scheduled meetings, and not even during the overnight lending window. And this has led to the S&P 500 to react like this. In the words of Marvin Gaye, what's going on? Let's get into it. Basically, all the junk that the banks are holding that they want the Fed to buy from them, the Fed isn't buying yet. The new Q4 bi-weekly operations are for Treasury Bills, not bonds. However, the big players like JP Morgan don't have a lot of Treasury Bills, they have a bunch of notes and bonds, probably much of which is overseas and negative yielding radioactive trash, which they can't yet pawn off. The big banks are trying to strong arm the Fed into opening up full-on quantitative easing like the post-global financial crisis in 2008 by not lending to the overnight market and leaving the smaller banks scrambling for cash to meet fractional reserve quotas. It's either that or end up literally insolvent by the time the stock market opens. Banks need to keep a certain percentage of cash on hand every day by federal law. That's the fractional reserve system. Banks are constantly spending your deposits and various financial instruments to make money. It could be equities, bonds, derivatives, whatever. The riskier the better, because they make more yield. And if it gets too risky, they now just expect the Federal Treasury to step in and bail them out. Because of all that spending, they have entire after-hours teams dedicated to making sure that the fractional reserve quota is met every night. They do this by lending out collateral, like bonds, to other banks for a certain percentage interest that they pay back the next day. The Fed gives a target rate that the bank should use when lending, among others, but it's really a market, and the buyers/sellers decide what rates to use. If there aren't enough loaners at the target rate, go back to part 1, then the banks can't lend their collateral out. There's not enough cash being offered in the market, in other words, a lack of liquidity. So banks have to ask for a loan at a higher rate of interest, meaning they have to pay back more the next day. This is just supply and demand at this point. Hopefully it's apparent how the market works and why a liquidity squeeze would cause rates to skyrocket like they did in September. Since there isn't enough liquidity, in order to force the market rate back down to the targets, the Fed has to step in and offer up cash at the target rate on the taxpayer's dime. Quantitative easing. But even with all this quantitative easing, the banks are still having trouble getting the cash they need. That's why the repurchase operations, i.e. repos, are still straining and in some cases oversubscribed. There's still more demand than supply, so the Fed has been forced to increase its quantitative easing limits even more. The real question is, why aren't other banks lending to each other? You loan it out and then get paid back interest the next day. It's guaranteed money. Unless, of course, they don't trust each other and think that there's a good chance that they won't be getting their money back because the bank they're loaning to is close to insolvency. Or maybe everyone in the system just has a lot less cash on reserve than everyone thinks. Or it's a combination of the above, and it's a power play by the elites like JP Morgan, for example, who actually want this repo crisis to happen, so the Fed is forced to start buying longer term bonds and not just Treasury Bills. Remember part 1. All of them are in trouble. Just the other day, McKinsey & Co released a report that suggests that the majority of banks around the world, not just the US or UK, don't have the equity returns to stay solvent in a market downturn. Maybe they'll be forced to merge with each other just like in 2008, and the debt bubble is so much larger today, percentage-wise too, not just in nominal terms, that it just won't work. The big boys will roll over, the small banks who depend on them will follow, and the whole system comes crashing down? Or will the Fed bail them out by printing trillions in cash and causing massive inflation? Maybe both. Some say gold is the only real money there is, and if you think about it, it's been a store of value for thousands of years now. Some are big fans of Bitcoin. I actually have a friend who studied physics at Oxford, and he has done very well for himself in the Bitcoin space. He thinks Bitcoin will end up being a key part of our transition from a Type 0 to a Type 1 civilization, and eventually act as a global reserve currency in the coming decades. But that's just his opinion, and of course not investment advice. Nobody really knows how bad this is going to be. Based on recent history, 2008, I would guess that it's going to be really bad for the working class poor and the middle class, particularly those in lots of debt. But I don't think it's going to be that bad for those who are red-pilled enough to diversify income streams and also have self-sovereignty over their assets. I could definitely see stocks go higher and even reach new all-time highs. Nobody really knows when this thing is going to pop. The Fed is clearly doing everything it can to prolong the inevitable. The good thing to do, the thing they should have done back in 2008, was to just let the market crash hard and let the banks fail because they messed up big time, right? It would have been horrible, but also cleansing for the economy in the long run. The problem with that was there was a good chance that the US wouldn't have emerged as still the #1 superpower in the end. And therein lies one of the real dilemmas and why it's not just the Fed but the whole aristocracy itself in Washington. Instead, they chose to print more USD, borrow ridiculous amounts of money from other nations, mostly China. The US is actually the biggest debtor nation in the world now, and we haven't seen a debt ratio this high since World War II. They took all this money and injected it back into the banking system to bail it out and reinflate the bubbles. Maybe they're going to try to do the same thing this time, but will it work again? The debt bubble is so much larger and countries all around the world are in similar states. Sooner or later, the whole monetary system may have to reset. Some say this is a mathematical certainty, unless magically all world leaders and CEOs can come together and agree on some miracle plan to simultaneously forgive and reset all global debt, which isn't going to happen obviously. So you may be asking why, if all this information is publicly available, why is the market not dumping? That's exactly why corporate buybacks and insider selling is at or near all-time highs. Inflows to gold, mining stocks and gold ETFs are at or near all-time highs. Other countries are hoarding gold. CEOs know it's about to pop. They want the stock market to be propped up quietly for as long as possible, so they can exit. They want to convince the dumb money that there's no recession, so they'll FOMO in and buy their bags. So what is the big deal? The ability of a nation to exercise violence is the only real currency, and the US dollar is backed by the ability to project military violence. The big crashes have already happened. People will still use the US dollar. There will constantly be a demand for it until the US military loses its dominance. However, the US military losing its dominance is literally called World War III, and it doesn't seem feasible that there will be a World War III because of the implications and the nuclear capabilities of many nations. But would China be stockpiling gold and building military bases in contested territory if it was planning on just going out quietly with the next wave of USD debasement? So it goes back to what I said at the start of the video. We are living in very interesting times indeed. Like always, for more compounded valuable content, like and subscribe.